Hare Krishna. Welcome to Tax Guru YouTube channel. This is CA Rohanar, a practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Mars Network. Welcome to our video series, What Law Says. And today we are going to discuss case laws reported to ITAT and reported to High Court under income tax. So let me allow to share my screen. What Law Says, Part 7. First case, Srimati Vimla Tripathi versus ITA number 310, Lucknow Tribunal 2023. Relevant assessment year is 2013-14. Date of order 31st December 2024. And relevant section is section 56, subsection 2, clause 7, subclause B, and Roman 2. Let's understand facts and issue of the case. The assessee filed her return for AY 1314 declaring income, and subsequent third-party information revealed that she had acquired agricultural land jointly on 1st August 2012 at a declared consideration of rupees 12 lakh, rupees 6 lakh share. Stamp duty valuation on the land was recorded at 71.3 lakh, creating a difference of 59.3 lakh between the stamp duty value and claimed purchase consideration. The AO treated half of this difference, that is 29.65 lakh, as income under section 56 subsection 2 clause 7 subclause B Roman 2 since the land was jointly purchased. Issue was can section 56 subsection 2 clause 7 subclause B Roman 2 introduced by Finance Act 2013 effective from assessment year 14-15 be applied retrospectively to transactions in prior years, that is AY 13-14. And another issue was the differential addition valid when the assessee had clearly documented actual payment to via sale deed and bank statements. Let's see what tribunal observed and held. The tribunal held that section 56 subsection 2 clause 7 subclause B Roman 2 applies only from 1st April 2014, that is relevant to AY 14-15 onwards. It cannot be applied retrospectively to land acquired during the financial year 2012-13 corresponding AY 13-14. It further observed that the assessee had unequivocally proved payment of rupees 6 lakh by way of sale deed and bank statements, invalidating any presumption of non-payment or gift. Noted also that agricultural land is not a capital asset under section 2 subsection 14 and thus section 56 deeming provision should not have applied to it in any case. Next, Navita Gupta versus ITO A.Y. 1718 559 ITAT 2025 Delhi Tribunal, date of order 30th April 2025. Let's understand facts and issue of the case. The assessee appealed against the CIT appeals order, which upheld an addition under section 69 read with 115BBE of the Income Tax Act. It was noted during appellate proceedings before the tribunal that the notice under section 143 subsection 2 was issued by ITO New Delhi. The assessment order under section 143 subsection 3, however, was passed by ITO Noida with no transfer order under section 127 to legitimize a shift in jurisdiction from Delhi to Noida. So, issue was whether the assessment framed under section 143 subsection 3 by the Noida ITO is valid in absence of transfer or jurisdiction shifting order under section 127, given that the initiating notice under section 143 subsection 2 was issued from the Delhi ITO. Let's see what was tribunal observed and held. The assessment framed by ITO Ward 523 Noida under section 143 subsection 3 is invalid and bad in law since there was no valid transfer of jurisdiction under section 127 from ITO Ward 38 to New Delhi. Consequently, the assessment order was quashed. As the quashing was on the legal point, the tribunal noted that the further adjudication of another grounds or other grounds would be academic and thus didn't proceed on merits. Appeal partly allowed, the assessment was quashed. Next, wait till the end of the video so that at the end of the video we will also see conclusions drawn from the today's discussions. So the one-liner conclusions will be helpful to you. You can take the screenshot of it also. So wait till the end and note down whatever points valid to you in your case. Next, CSJ Infrastructure Private Limited versus ACIT relevant AY 1415 and 1516, ITAT 2025, Chandigarh Tribunal date of order 28th May 2025, and relevant sections section 36 subsection 1 clause 3 and section 43 CA. Let's understand facts and issue of the case. Assessee purchased 20.16 acres of land from Pfizer Limited, paid conversion fee partly upfront on balance in installments with 8.25% interest. Interest during construction phase was capitalized. Post-use, that is more operational from March 2013, interest claimed as a revenue expenditure under section 36 subsection 1 clause 3. AO disallowed treating it as a capital in nature. CIT appeals allowed holding interest post-use is revenue expenditure. On property sales, AO applied section 43 CA relying on the DVO's valuation. CIT appeal held that where no collectorate rate was available, stamp duty value in sale deed should be accepted. Also directed to include interest on delayed payments in sale consideration. So issue whether interest on unpaid conversion fees for the period after the mall was put to use constitutes allowable revenue expenditure, and whether in absence of prevailing collectorate stamp duty rates, the value declared in the sale deed is to be accepted, and whether interest on delayed payment should be aggregated with sale considerations for valuation comparison. Let's see what tribunal observed and held. On section 36, subsection 1, clause 3, the tribunal upheld the CIT's appeals decision, affirming that the post-use interest qualifies as revenue expenditure and is allowable. AO's appeal was dismissed. And on section 43 CA, where collectorate stamp duty rates were unavailable on the agreement date, the sale deed value on which stamp duty was paid is to be accepted as correct, no addition warranted. Interest on delayed payment must be added to sale consideration and compared with DVO valuation under section 43 CA to determine any addition. Next, Tapan Kumar versus ITO 1660 Kolkata Tribunal 2024. Relevant assessment year is 2017-18. Date of order 11th March 2025. And relevant section is section 143 subsection 2. Let's understand facts and issue of the case. The assessee filed his return declaring total income of rupees 3,75,000 on 30th October 2017. The case was selected for scrutiny via CAS, Computer Assisted Scrutiny Selection. The AO issued notices under section 143 subsection 2 and 142 subsection 1 along with a questionnaire, which were duly served. Subsequently, due to non-compliance by the assessee, an ex parte assessment order was framed under section 144 on 27th December 2019, adding rupees 25,74,000 under section 69A for unexplained deposits made during demonetization. issue was whether the notice issued under section 143 subsection 2 was valid when it didn't conform with the format prescribed in the CBDT instruction dated 23rd June 2017, and if not, whether the result on assessment under section 144 is void or not. Let's see what tribunal observed and held. The additional legal ground was purely a legal issue with all relevant facts on record. Accordingly, the tribunal admitted it under the principles of Jute Corporation of India Limited versus CIT and National Thermal Power Company Limited versus CIT Supreme Court decisions. The tribunal found that the section 143 subsection 2 notice failed to comply with CBDT instruction dated 23rd June 2017, rendering it invalid. As a result, all proceedings arising from that invalid notice, means proceedings arising or based on the invalid notice, are invalid and void ab initio. Means you have to keep in mind that whenever the proceedings based on invalid notice can be void ab initio. Okay. So the judgment cited earlier coordinate bench decisions that supported this ruling. Consequently, the assessment order was quashed, upholding the order of the CIT appeals to restrict additions to profit elements, and the matter was remanded to the AO to reassess income by applying a more reasonable profit rate aligned with the industry standard of 8 to 10% of unaccounted receipts. Next, Ramavtar Goenka versus ACIT, relevant assessment years 1819 and 1920, Ahmedabad Tribunal 2023, and date of order 30th May 2025. Relevant sections are section 28, 68, and 69C. Let's understand facts and issue of the case. The assessee active in real estate and part of the Sankalpa group was subject to a search on 30th October 2018, where handwritten diaries, unrecorded bills, and other documents evidencing on money dealings, unaccounted cash sales, and unrecorded payments, land, brokerage, salaries, jewelry were seized. The AO treated these unaccounted receipts as undisclosed income and unaccounted payments as unexplained expenditure under section 69C, rejecting the assessee's contention that only the profit element 8 to 10% of such receipts should be taxed. CIT appeals on appeal limited the addition by applying a profit rate of 40% on unaccounted payments as they exceeded the receipts. Issue was whether the addition should cover the entire amount of unaccounted receipts or payments or be restricted to profit element embedded in those transactions. If only profit is taxable, what is the appropriate rate to apply? Should the CIT appeals 14% be applied, or should it adhere to the more realistic industry standard 8 to 10%? So let's see what tribunal observed and held. The tribunal agreed with the CIT's appeals approach of taxing only the profit element rather than the full quantum of unaccounted receipts. However, it held that the applied 14% rate was excessive given actual profit levels in the real estate sector. The tribunal directed the AO to reassess income, applying a more reasonable 8 to 10% profit rate on unaccounted receipts to ensure only real taxable income is captured. Appeal partly allowed for the assessee profit-only approach, and revenues appeal dismissed full amounts not taxable. Next, Bhakt Samaj Vikas Education Trust versus ACIT IT number 775, Ahmedabad Tribunal, relevant AY 2122, date of order 25th June 2025, relevant section is section 11. Let's see facts and issue of the case. The Bhakt Samaj Vikas Education Trust, a charitable trust registered under section 12A, filed its return of income for AY 21-22 on 29th March 2024. The return was processed under section 143 subsection 1, and the exemption under section 11 was denied solely because the audit report in form 10B was filed late, missing the due date under section 139 subsection 1. So issued, the CIT appeals upheld its denial, prompting the trust to appeal to the ITAT whether the delay in filing form 10B audit report before the due date for filing a return justifies denial of exemption under Section 11, particularly when the Form 10B is furnished before passing of intimation under Section 143, subsection 1. Very interesting. Let's see what tribunal observed. And the tribunal referenced Gujarat High Court rulings and other judicial precedents holding that delay in filing Form 10B is merely a procedural default. Delaying Form 10B, that is audit report, is a merely procedural default, not a substantive bar to exemption, provided other legal conditions are satisfied. Since the audit report in Form 10B was filed before the assessment or intimation under Section 143, subsection 1, the tribunal ruled the trust should not be disqualified from claiming exemption under Section 11. Thus, the tribunal allowed the appeal of the SEC, that is the trust. And now we are moving to the cases reported to High Court. CIT LTU versus Reliance Industries Limited 2025, Bombay High Court, date of order 21st June 2024, and relevant section is section 9, subsection 1, clause 6. Let's see what was the issue of the case. Whether payments made by Reliance Industries Limited to non-resident software suppliers for purchase of computer software under licensing or distribution agreements amounted to royalty under Section 9, subsection 1, clause 6, thus taxable in India and requiring TDS under Section 195. Let's see what Bombay High Court observed. The assessee had acquired only a license to use the software without any transfer of copyright ownership. Assessee had acquired only a license to use the software without any transfer of copyright ownership. The non-resident suppliers retained all the intellectual property rights with them, and the assessee could not exploit or sublicense the copyright. This was a case of sale of copyrighted articles, software as goods, and not a transfer of copyright itself. It was a case of sale of copyrighted articles like goods, that is, the software as a goods, and not a transfer of copyright itself. The issue was already covered by the Supreme Court judgment in Engineering Analysis Center of Excellence Private Limited, which clarified that such software payments are not royalty. Payments made for acquiring software under such distribution agreements are not taxable as royalty under Section 9, subsection 1, clause 6. Consequently, no withholding under obligation under Section 195 arises on Reliance Industries Limited. Revenue appeal was dismissed. Next, Wavy Constructions LLP versus ACIT AY 1213 2025. Bombay High Court, date of order is 20th December 2024, and relevant sections are section 143 subsection 3, 144B, 147, 148, 153 subsection 3, clause 2, and section 260. Let's see what was the issue of the case. Whether the reassessment notice under section 148 and consequent assessment order under section 143 subsection 3 read with section 147 and section 144B are valid, specifically regarding whether the proceedings were time-barred and beyond the period of limitation under section 153 subsection 3 clause 2. Let's see what Bombay High Court observed and held. The High Court concluded that the reassessment order is beyond the period of limitation, that is invalid in law. The department cannot claim extended period benefits when the reassessment arises solely as a consequence of court's direction. The court quashed the assessment order and remanded the matter, directing the assessee officer to reconsider the objections filed by the assessee and proceed accordingly without making any observations on merits. Key principle herein is limitation period cannot be extended merely by virtue of following court directions. The reassessment thus stood invalid ab initio. Next, Ujala Dyeing and Printing Mills Private Limited versus DCIT, assessment year 1890 2025. Gujarat High Court, date of order 4th March 2025, and relevant sections are section 119 subsection 2 clause B, section 143 subsection 1 clause A, and section 237. Let's see what was the issue. whether the delay in filing a corrected or revised return due to misplacement of figures in the wrong written columns under section 119 subsection 2 clause B could be condoned even though the correction was submitted after the statutory deadline for revised returns for purpose of processing the return and allowing the refund under section 143 subsection 1 clause A. Very interesting. Let's see what Gujarat High Court observed. The taxpayer mistakenly reported disallowance details in incorrect column of the return, but income remained unchanged. Okay, incorrect column of the return, but income remained unchanged. This error caused CPC, that is Central Processing Center, to raise a mismatch. The correction was made in response to the CPC intimation, but the deadline for filing a revised return, 31st March 2019, had already passed. The mistake was purely technical, a presentation error with no substantive impact on taxable income. What is was the cause of the case's mistake was purely technical, a presentation error with no substantive impact on taxable income. Section 119 clause 2 subclause B section 119 subsection 2 clause B empowers the tax authority to condone the genuine hardship, and the authority should not mechanically reject the application when the error is trivial and harmless. So, according to section 143, subsection 1, clause A, processing of return involves mathematical and clerical corrections. These corrections falls within that scope and should have been allowed, especially since the income amount didn't change. The Gujarat High Court quashed the order rejecting the condonation under section 119, subsection 2, clause B. The authorities were directed to process the corrected return as per law, allowing the refund claim, including interest if applicable, even if recovery or adjustment occurred in the interim. Malay Car versus Union of India, relevant assessment year 13/40/2025, Orissa High Court, date of order 3rd May 2024. Relevant sections are section 199 and 205. Issue of the case: whether an assessee, that is employee, should bear demand, including interest, under section 234B to 234C when tax was deducted at source by the employer on time but not deposited with the government, resulting in mismatch in Form 26 days and consequent short credit. Very interesting and relevant. Let's see what Orissa High Court observed. And Section 205 of the Income Tax Act expressly bars enforcement of tax demand, enforcement of tax demand against the assessee in cases where TDS has been deducted on time but not deposited by the deductor. The CBDT circular dated 1st June 2015 and office memorandum dated 11th March 2016 reinforced this statutory safeguard by instructing departments not to deny benefit of TDS to the assessee where mismatch is due to non-deposit by the employer. The mismatch in Form 26 says is impermissible grounds to deny TDS credit to the assessee or to raise recoveries during such instances. The statutory language is clear. If tax has been deducted, the obligation to collect it must be discharged by the deductor. It cannot be passed on to the deductee. Very, very much important. So the court held that since tax was deducted at source, the assessee cannot held liable to pay the amount, even it hasn't reflected in Form 26. As the department cannot enforce the recovery partially, the observed legislative and administrative framework, including Section 205 and CBDT directives, must be fully complied with, ensuring TDS benefits are duly available to the deductee, regardless of deductor's failure. Effectively, the TDS credit must be granted to the assessee, and any undue recovery or adjustment against must be refunded with interest if already effected. Next, Anvil Cables Private Limited versus State of Jharkhand 2025. Jharkhand High Court, date of order 8th April 2024, and relevant sections are section 195 and 201, subsection 1A. Let's see what was the issue of the case. whether the statutory authority, that is JBVNL, entering into a contract with Anvil Cables Limited for supply of materials and engineering works could deduct tax at source but not deposited with the income tax department and retain part of the contractor invoice payment, citing income tax contingencies when the amounts deducted were not deposited, thereby denying the contractor TDS credit and retaining funds that belong to them. Let's see what Jharkhand High Court observed and as a statutory authority, JBVNL had a commercial and statutory duty to act fairly in its contractual dealings and could not misuse deduction powers to withhold payment. JBVNL had no legal basis to retain any amounts from the contractor's bills on account of income tax contingencies, particularly where the amounts deducted were not deposited or accounted for. The High Court directed JBVNL to return the withheld amount and along with the applicable interest to Anvil Cables Limited, a cost was imposed on the statutory authority to be recovered from its managing director, underscoring the seriousness of the breach. And now we are moving to the conclusions that can be drawn from the cases discussed today. So let's see what are the one-liner conclusions. First, Section 56, subsection 2, clause 7, subclause B, Roman 2 cannot be applied retrospectively to a land purchase made before its effective date, that is 1st April 2014 in the 11th case, especially when valid consideration is substantiated. The addition was therefore quashed. An assessment made by an AO without a valid transfer of jurisdiction under Section 127 is void ab initio. Only the profit element of unaccounted receipts is taxable, and post-use interest on conversion fee is allowable as a revenue expenditure under Section 36, subsection 1, clause 3. A notice under Section 143, subsection 2, issued in violation of CBDT's prescribed format is invalid, rendering the assessment void. That is based on that invalid notice is void. In such cases, additions must be restricted to profit on unaccounted dealings and not the entire unaccounted turnover. Delay in filing Form 10B, that is audit report, is a procedural defect in case of trust. Exemption under Section 11 cannot be denied if conditions are otherwise satisfied. Payments for software use or distribution are not royalty under Section 9, subsection 1, clause 6. No TDS liability arises. Reassessment beyond the statutory limitation period under Section 153, subsection 3, subclause 2 is invalid and must be quashed. Procedural mistakes in written filing can be condoned under Section 119, subsection 2, clause B. Refunds cannot be denied if income is correctly offered. Under Section 205, the assessee cannot be penalized if TDS is deducted but not deposited by the deductor. Credit must be given. And statutory authority cannot unfairly withhold payments citing TDS contingencies. Withhold amounts must be returned with interest. So that's it for today. You can note down my contact numbers. You can share your suggestion, observations, and any kind of question or query to my email IDs mentioned herein. So hope you are all benefiting from this video series which I am conducting on Tax Guru YouTube channel. That is what law says for income tax and GST Relearn video series. So stay tuned to Tax Guru YouTube channel. If you are not yet subscribed, then do subscribe Tax Guru YouTube channel. If you like the video, please click on like and also share in your network. So stay tuned. Let's meet in next video. Till then, bye bye. Take care. Hare Krishna.